Everybody,
Let's go.
welcome to the morning market briefing, June 10th, 2022. Big day CPI coming out. Obviously, that's going to have a massive impact on markets. We're going to get to that in a moment. We want a few minutes to digest the number that just came through, get a little more commentary rather than just read raw numbers to you. Dow futures down 7 basis points, S&P futures up 6, NASDAQ futures up 28. I think it's going to be pretty interesting to see how those respond, even with length of this call. We will come back to CPI momentarily, so stick tight. I know that's why everybody is here. Let's open up with Janet Yellen, a little bit off the reservation, speaking to the New York Times at an event. Tom, what stood out to you on the commentary? It seemed a little bit like a change of tune.
Woof. It was Janet Yellen. I don't know who's letting her walk out there and talk to people, but I think she's a little bit I feel like she's being a bit of a puppet, to be honest, saying things that are either blatantly not true or obvious to everyone else. And, she's just sticking to sort of the script. So first things first, on policy, speaking about whether or not, they would do things differently now that inflation is out of control. She said that they definitely would not do it. In terms of curbing inflation, to quote the quotes she had were, look first and foremost for the Fed to deal with inflation, aka they're going to be the fall guy. I think that's been being set up pretty specifically here, and we'll definitely talk about that when we get to the inflation number. She said that gas prices are unlikely to fall anytime soon. She said that she is on board with being very aggressive with antitrust stance. So look for mergers and acquisitions to be embroiled going forward. On the recession, this is where it got really weird. She said there's a large buffer of stock in savings. So basically saying that people have plenty of money, they're all saving. There's a 20% recession risk in any given year, which I'd be interested to see that data. It seems like it's just sort of an off the wall.
Yeah, if that's the case, why are we not having one every 5 years? That seems quite predictable.
She said that there's nothing to suggest that a recession is in the works. She says she absolutely expects a growth and slowdown, and I don't think we are going to have a recession. And then the one that I thought was perhaps the most off base was, it's amazing how pessimistic households are given job gains, which I think is perhaps the most I'm out of touch, I have no idea what's going on statement of the day. Because, I can tell you anecdotally, my brother works for a startup here in Atlanta, and they laid off a third of their workforce yesterday with no warning. Luckily he made it through, but their headcount was reduced by 950 people all before noon yesterday. They all just got either a call or an email that basically said, pack your stuff, you're out of here. We saw Stitch Fix announce that they're going to release 15% of their employees. Tesla's already said 10% of theirs. It's very possible. Sure, we've had these, skipping along where we're picking up 100,000, 200,000 jobs here and there. But I think that saying that while knowing for sure that, I think it's entirely within the realm of possibility that the next jobs report, we could lose 1 million jobs. And I think that would, it's not a good thing, but I think it might actually indicate what the Fed is doing is starting to trickle through, which in theory will bring down inflation, which brings us to our next topic, which is we got the CPI print this morning. And I don't know who wants to break the bad news.
Let's not go there yet, because I still have more to bag on Yellen. I don't know how you say I wouldn't have done things any differently 8 days after saying I was wrong about the path inflation would take. Last week we talked about how ridiculous it was that she acted like there were these new unanticipated shocks to the system, shocks that we were all talking about, many of them for the last 2 years. It doesn't gel to say, man, I really misunderstood and misinterpreted that. But you know what? I do it all over again.
Here's a fun fact. Do you know when year over year disposable real income growth peaked?
2005.
March of 2021.
No,
the very same month that the stimulus was passed. Every single month since then, real disposable income has been down on a year over year basis. So to say that the stimulus really helped us out is, it doesn't hold up.
Yeah, when you're trying to pay $200 for a tank of gas, it feels real stupid to be wearing those Air Force Ones.
Yeah, it's like you put out a huge buffet of food, and we really needed some cake.
Yeah,
we got to get some sugar on here. Ben, you ready to jump to CPI? Or we want to hit, hit Sohn first.
Let's hit Sohn first.
So Sohn, big investor conference.
What a tease.
Ben's really having a hard time with this. He's really trying to digest it. Einhorn was out. Famous hedge fund manager says he's very bullish on gold. Stan Druckenmiller said that the chance of soft landing is pretty remote. I agree. One comment Druckenmiller made that is just, I still am struggling with. I don't think I'm the smartest guy in the world. I think Logan is, our producer, but the refusal of really, really smart people to not say, hey, we're probably in a recession. I don't understand what's going on. Do they not know what a recession is? I mean, we saw a GDP decline. We're continuing to see the estimate for current quarter GDP fall. I mean, maybe we don't go negative, but I kind of think we are. We're certainly trending in that direction. So when you hear people say, like, we're not going to have a soft landing, but, you know, who knows when a recession's coming, maybe 2023, maybe earlier. I don't know. I don't understand why people aren't just saying, hey, it's probably happening right now.
The Bank of America credit card data came out, and I think this is exactly why people are having trouble with it. And Druckenmiller, to his credit, does say that this is his 45th consecutive year as a chief investment officer. He's never seen an economy where there's no historical analog like today. And he says that's given me more humility than ever. So he would be hand in the air. I don't really know what's going on in the economy. I don't care. I dropped out of my PhD program. I'm a markets guy. I'm just trying to get the market right. And we're in a bear market, and that's very, very likely to continue. So that's kind of his thing. On the economy, I agree with you, Andrew. I think that it's more and more clear that we're in a recession. And that credit card data, like I said, is displays the point very clearly. It's up 5% on a year-over-year basis, card spending. So you think that's good growth. No, it's not when you have inflation.
That a number will tell you soon.
Yeah, that is higher than that. So you're actually seeing declines in real terms. We've seen declines in real disposable income for the last year. And that's going to have an impact, no matter how many savings that Yellen says still exist in savings accounts. So that's going to be drawn in relatively short order if you keep declining at the rate we're declining.
Yeah, it's just some of the commentary here is interesting. The Sohn conference, I mean, it certainly makes headlines in our circles. I mean, do you think there's anything particularly actionable or something you feel like, hey, this is a major takeaway that everyone out there needs to be paying attention to?
I think Druckenmiller makes a good point on energy, saying that he's still long energy and commodities, but he's looking for signs of demand destruction, because that will come. In 2008, we saw energy, oil prices hit a very high peak and then immediately collapse. And I think you have different dynamics going on this time, but I think that he is right to point out the demand side. I also think he makes a good point that the worst trouble people get into is when they have stale longs or stale shorts. That's why we continue to try to refresh our ideas every quarter.
Yeah, no, I agree. All right, let's jump to CPI. Maybe we start here with just the numbers. The month over month expectation was for a 0.7% rise on the headline number. The last reading was 0.3. Year over year expectation, 8.2%. The last reading was 8.3. So we're looking for a slight downgrade, excluding food and energy, looking for a year over year number in the 5.9 range. The last reading was 6.2. And we talked about this at length yesterday in our preview. I just had a hard time seeing how we weren't going to be north of 6 on that ex food and energy number. Where do we come in on headline? Where do we come in on ex food and energy? So
on headline, we posted 8.6, which is a new cycle high, up 1% on a month over month basis, which obviously annualizes a lot higher than 8.6%. So you see an acceleration there. On the month over month, on the core, we're up 0.6, same as last month, and up 6.0 on a year over year basis. So basically, inflation is not coming down. And that's the big takeaway. I would say versus expectations, the lion's share of the difference is that food and energy, which people are inclined to strip out. But as I look at it, I'll hand off to Tom here in a second. But it was exceptionally broad-based overall. Transportation, you actually had come down from a 3.1 month over month to a 1.3. So that was only up 7.9% year over year, which seems like a lot, but it's certainly a big decline from where we were before. Where you saw an acceleration was on shelter prices. But even their shelter estimate, they're still only talking about a 0.6% increase on a month-over-month basis, which is only 5.5% year over year. And I think we all know that shelter prices are higher, going up higher than that. Used car prices went up versus April. And then if you just look through some of the commentary that they have in this report, they talk about medical care up 0.4%. You talk about household furnishings up 0.4%, same as last month. Recreation up 0.4%, apparel up 0.7%, and multiply all these by 12. So all these 0.4s, 0.7s,
Compound them by 12.
Compound them by 12. So if you think about that, in order to be at 2%, you really need to be between 0.1 and 0.2% on all these numbers I'm reading out. And we're at 0.4, 0.7. What else do we have? We have motor vehicle insurance up 0.5. We have, where was I? We have personal care up 0.4, education up 0.3, tobacco up 0.9, alcohol up 0.5. We're seeing broad-based inflation that even if we begin to decline at some point, even if these food and energy prices begin to come off the boil, first of all, they're going to feed through into these other commodities that we're talking about. But secondly, there's that broad-based inflation that even if we get back to 0.1 and 0.2 on all of these, we're still talking about shelter prices that are up 5-6% on a year-over-year basis. It's just going to be very difficult to come down. The Fed's going to have to raise faster than expected, and this sets up for a very tense, fraught meeting next Wednesday at the Federal Reserve. Will they raise by 50, or will they just try to shock and awe and really get this thing down? I think right now we can start penciling in a 50 basis point hike in September if they don't.
Yeah, I mean, if you look at futures now, we're seeing a tick up. We're closer to 11.6 potential hikes. I think this morning was 11.4. Last week it was 10.4. So we're baking in another potential rate hike. The yield curve is selling off aggressively on the short end. And actually buying up very strongly 5 years and out. And so we're getting much closer to another yield curve inversion. Right now, the 2-year treasury is at 2.89, 2.9%. It's kind of bouncing around a little bit, but the 10-year treasury is right at 3%. So you're looking at 10 basis point spread between a 2-year and a 10-year. I mean, that's one trading day away from being inverted again. But we're extraordinarily flat on the yield curve. In fact, the 5-year treasury is higher than the 10-year. And it's almost as high as the 30-year. So we've got this weird, almost, wave shape on the yield curve, which indicates more rate hikes coming. And I mean, it's going to be a bumpy ride here today on the bond market on the short end.
One thing that Druckenmiller did say yesterday, which has application here, he said that we haven't, once inflation's gotten over 5%, we've never gotten inflation back to 2% without raising rates above the level of the CPI.
So what's that, 40, 45 rate hikes at this point?
And I continue to contend that until we hit, I said before, 12 to 14 hikes, I think the Fed's gone too slowly. Now I'm revising that to 13 to 14. We need to have expectations for 13 to 14 rate hikes before we can start saying, okay, we're starting to kick inflation here.
Yeah. I mean,
we're at 11.6.
They played this all wrong from the beginning.
I wouldn't do anything differently.
Yeah, but they wouldn't do anything differently, despite the fact that they're openly saying they didn't know it was going to go like this. I mean, this is tough, man. The lack of foresight and leadership of those who are most capable of making a change here seems to be just asleep at the wheel. I mean,
we're seeing equities just get pummeled. Go ahead, Ben.
And I think what you're saying is a big takeaway, because people know we have inflation. This number, it's a number. It's like, you're feeling not good, you're feeling sick, you're taking some Tylenol, and then you take your temperature and it's a 101.5. And you say, oh, I must be sick. Yeah, you're sick. There's no surprise in that. You just have a number to quantify that. But you're doing the right things. You're taking the medicine. The thing is, right now, we haven't taken the medicine. And I think that's the issue. It's not the fact that we're running a 101.5 temperature. It's that we're not medicating.
Yeah, we're not doing anything.
You need to get that down.
Yeah, you got a high fever, and what are you doing? You're just chilling and watching TV.
And then it's going to keep going up. You'll hit 104, and then you're in the ER.
Yeah,
and that's what we're trying to avoid, and the Fed's not doing that. And that is the issue, not that you just printed a 101.5.
Yeah.
Yeah, It's ugly. We talked momentarily ago just about where we were standing on futures. We now have Dow futures down 2%, S&P futures down 2.4, NASDAQ futures down 2.8. As a reminder, 14 minutes ago, NASDAQ futures were up. There doesn't really seem to be any real shelter. Gold has sold off since the announcement. Even something as stable as Bitcoin has really just fallen off a cliff in the last 10 minutes.
Tom, have we seen anything else on the Fed?
No, it's still,
Sorry,
yeah,
Oh, you're
sorry.
good.
No, we're hovering right at 11.6 right now.
I mean, it's just, I think the only thing that's surprising to me is that the market seems a little surprised by this.
I agree. And I think that this is probably
An overreaction.
a bit of an overreaction. I think that a lot of people will not want to buy ahead of the Fed meeting because I think this does increase the probability that, I mean, if you're going to surprise the markets at this point, don't do 75 basis points. Go a full percent at your next meeting. Just
Do
go
2%. Just do it. If we need 11 this year,
if
just
that's
do
where
the
we're
11.
going.
Go to 8.
You know, like just do it. Yeah.
I mean, I think I frankly think that will be good for the market. But until we see that leadership, until we take the medicine, it's not gonna be good.
Tom, what do you think we could see some potential pricing in of more than 2 hikes, more than a double hike next week? Do you think we'll ever see that showing?
I mean, it's not showing now.
It's such short term that there may not be enough time for.
I mean, there's sort of an implication somewhere between September and November that we're going to see more than 2, but it's still only 2 and change. I mean, unless they come out and say it, I don't think that the futures are going to indicate that because, I mean, again, those are people speculating in the markets as well. I mean, this is just, it's almost like if you're watching a zombie movie and instead of, shooting the zombie in the head and ending the problem, they're like, oh, come on in. Well, we'll put you in the guest bedroom. We'll just let you hang out in here. And then suddenly everyone in the house is a zombie.
No,
But you have to leave tomorrow.
Yeah.
I'm going to give a silver lining. Here's a silver lining. And that is if we hit, what was the estimate? 8.2 was the estimate and 5.9 on the core. If we hit those numbers, the Fed was going to do 50 basis points this month. He's going to do 50 basis points the next month, maybe 25 basis points the following month, and not really kick this thing. This could be the catalyst where the Fed says,
we got to do something.
We have to do something. We have to be aggressive. And I said it a couple of weeks ago, we should aggressively raise. And instead they went the other way. And now I think hopefully this can kick them in and actually see what the rest of America is feeling right now, because apparently Janet Yellen doesn't feel it. I don't know if Jay Powell feels it. It doesn't seem that way. Raphael Bostic definitely doesn't.
There seems to be zero sense of urgency.
But that's my concern is I hear your point, Ben. I'd like to think that's right, but I think what we're hearing, I mean, Yellen's a perfect example, and I realize she's not making Fed policy at this juncture, but she is, one of a handful of people that can actually influence this stuff. When she trots out to a New York Times event and essentially gives political talking points, and you combine that with an administration that continues to do victory laps about jobs, she's reading their talking points yesterday. Amazing how pessimistic households are given the job gains. I think there's some truth. I mean, one of the things Einhorn said is that, the Fed is bluffing. I don't know that this will be the wake-up call that it should be.
I think their bluff just got called.
Yeah.
And I think that the jobs thing is a bluff too. And they're going to have, I think there's going to be 5 million jobs lost in the next 6 months. And they're going to look like idiots and they're going to all lose their jobs. Also.
Yeah. I was reading an article this morning that said heads are going to roll after the midterms. The interesting thing to me is this also, not only is this bad on the inflation side, it's also bad on the recession side, because right now, all of the calculations are made. You calculate the total output and then you subtract inflation. So we have an output number that is, call it 9 or 8, call it 8. And then you subtract what the inflation number is. Now, if that inflation number is going to come in at 7, yeah, maybe we post 1% growth this quarter. If that inflation number comes in at 9, we're posting negative growth. We're officially in a recession. And at that point, what does the Fed do? And they're in a box.
Yeah. I mean, the expectation for Q2 is what, 0.9? And we came in 0.3 ahead.
Yep.
Like, so that takes a third of it off the top. If there's any wiggle room there, we're in a recession for sure, which
Yep.
I think is at this point almost a certainty, unless the Fed does something, unless someone does something, but no one's doing anything.
Yeah, there's got to be something that we're just not aware of, I think, for us to not technically print a recession in this quarter.
I mean, I don't know what it would be. I mean,
we're, believe it or not, we kind of look at a lot of stuff, and there's just nothing that seems rosy.
Oil companies are making a lot of money, but
they don't want them to.
But they don't want them to. Yeah, so it's not good.
It's bad. Good. We're gonna wrap it up here. We're gonna get to work today. Maybe anything potential buying opportunities, even if this is oversold, or are you more of the mindset to sit tight till Wednesday?
Yeah. I actually do. The Fed won't talk until Wednesday because they're in the quiet period. But I think that you're going to start to see some articles and see the Fed moving quicker. And I think that that's going to alarm people initially, but I think that that's actually a buying opportunity spaced out and slowly and in the right places. I want to caveat it with that. And so there's some optimism there. I would say for clients, we will be publishing our first ever market memo at 3 p.m. today. That'll give you a broad, if you're on the call, you'll probably know a lot of what we're talking about, but it'll be a nice email form. It's just a one pager, kind of quick hitters on everything that we're seeing and our view of the markets.
Awesome. We're going to wrap it up there. We'll talk to you guys on Monday. Look out for that market memo. If your client should be coming out around 3 p.m. to your email. I hope you guys have a good weekend, and we'll talk to you soon.